Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the big corporate world and get a little bit of that insider knowledge. In this report, we're going to dive into some interesting distribution changes from FS Credit Real Estate Income Trust Incorporated. Let's get right into it and see what the company is telling us about its payouts to shareholders. Alright, so right off the bat, we see the report is dated the 15th of January 2026. This tells us it's a current report about significant events happening around that time. Companies like this have to tell us when something important changes, and this report is all about a change in how they pay out money to their investors. The company we're looking at is FS Credit Real Estate Income Trust Incorporated. Think of them as a company that invests in real estate and then shares the income generated from those investments with its shareholders. They're incorporated in Maryland and have a commission file number of 000-56163. This is just basic company identification stuff. Their main office is located in Philadelphia, Pennsylvania. But honestly, where they are physically located is less important for us than what they are actually doing. They also provide a phone number, but again, we are more interested in the financial story. This is an interesting little detail. It means their securities are not directly listed and traded on major stock exchanges, like the New York Stock Exchange. This often means they operate a bit differently than publicly traded giants. Now we get to the meat of the report, the actual news they want to share. The big news here is about a distribution recommendation. This is basically a fancy way of saying they are recommending a change to the money they pay out to shareholders, also known as distributions. So the company's board of directors, after getting advice from their investment advisor, has decided to lower the monthly distribution. This change will start with the shareholders who own the stock on the 26th of February 2026. A reduction in distributions means shareholders will receive less income from their investment. Why did they cut the payout? They tell us they looked at a lot of things like interest rates right now and what they expect them to be. They also considered how much money they are borrowing, how fast new money is coming in, and when they expect to get money back from loans they've made or refinance deals. This is all about managing the real estate investments and the income they generate. Here are the actual dollar amounts for the February distribution. You can see different classes of shares get different amounts. For example, Class Y shares get the highest at about 17 cents, while Class S and T shares get about 13 cents. This is the last full distribution before the cut takes effect. Now they are showing us the annualized distribution rate as a percentage of the share price. This is important because it tells us the effective yield an investor is getting. For instance, Class Y shares had an annualized rate of over 8.7%. But remember, this is based on the distribution before the reduction. The new rates will be lower. They stress that they will keep watching the market and how interest rates affect their investments. This means future distributions could change again. And here is a very important legal disclaimer. They are basically saying that the board decides how much to pay and when to pay it, and investors should not assume they will get the same amount in the future. This is standard but underlines that while they aim for stability, distributions can fluctuate. This section is a standard legal warning. They are telling us that some of the things they've said or implied and will say are forward-looking statements. This means they are talking about potential future events like how much they will distribute or how their investments will do. These are educated guesses based on current information, but they are not guarantees. They explain how to spot these forward-looking statements in their reports. Look for words like may, will, expect, anticipate, or similar terms. It is a way for them to protect themselves if things don't turn out as predicted. They are basically saying that while they believe their predictions are reasonable, things could go wrong. Their actual results could be very different from what they are suggesting. This is a very common and important disclaimer in financial reporting. It means don't bet the farm on what they say about the future because it might not happen. And finally, they are not obligated to update these future statements unless the law requires them to. This means if something changes significantly after they file this report, they don't have to tell everyone immediately unless law forces them to. And here is the signature section. Stephen S. Seifert, who is the Vice President, Treasurer, and Secretary, has signed off on this report on the 15th of January 2026. This confirms the company is officially submitting this information. So what does all this mean for investors? The core message is that FS Credit Real Estate Income Trust Incorporated is decreasing the amount of money it pays out to its shareholders each month. They are doing this because they are looking at broader economic and market conditions. While this might be disappointing for investors relying on that income, it could also be a sign of responsible management. Instead of paying out money they might need for future investments or to weather economic storms, they are adjusting their distributions. This type of adjustment is not uncommon in the real estate investment world, especially when interest rates are volatile or the market is uncertain. It suggests the company is prioritizing the long term health of its investment portfolio over maintaining the current distribution level. However, the key takeaway is that distributions are not guaranteed. The company explicitly states that the board has discretion, and investors should expect that payouts can and will change based on market conditions and the company's performance. For investors, this highlights the importance of understanding not just the current yield, but also the underlying strategy and risk management of any investment. What is your take on these distribution cuts? Do you think it is a wise move for the company to protect itself, or is it a sign of trouble ahead? Let us know your thoughts in the comments below. If you found this deep dive into the FS Credit Real Estate Income Trust filing helpful, please hit that like button and subscribe to Corporate Decoder for more breakdowns like this. Also, don't forget to join our Discord community linked in the description for further discussions. Thanks for watching, and we will see you in the next video.